All right, let's check the markets. We're green across the board. So we've extended record highs. Ed Yardeni says confident the market hit its low on March 30th. Tom Lee went a step further than that yesterday on closing bell. Listen to this.
I know this is going to sound counter to what the viewers might think, but I think the stock market is in a better position today than earlier this year when it made its all-time high.
Well, okay. He says the market proved that it can handle a spike in oil. Earnings are still solid and actually going up. Do you agree with Mr. Lee?
Well, I can't disagree in terms of the market interpreting what we've seen happen recently as a settled issue. I don't know if it'll turn out that way, but we've retraced the entirety of the start of the war's jitters in price. Not every stock, and we'll get to that in 1 second, but I think now the next test is going to be, are these earnings good enough to have justified the rebound that we've seen? And it ain't going to matter until we get to the Mag 7 names and those earnings. Not only are those companies very important statistically as far as their index weight, but the earnings growth coming from not only those companies, but from that entire ecosystem that those companies are fueling in the form of the AI CapEx spend. And all of the recipients, whether we're talking about the Dells of the world, the Cienas, the Ciscos, or we're talking about the semi names. So that's really what's going to be the story, and it's too early to declare victory. I do think it's interesting that we've got this huge divergence in price action in stocks versus consumer sentiment. And I don't really trade around the University of Michigan consumer sentiment, but it has to be brought up. The reading is down 10% from where it was in March. The drop in sentiment is mostly from the spike in inflation, obviously gasoline prices. Respondents are seeing prices up 4.8% in a year from now. So they think that the inflation resulting from this will be way stickier than what we're seeing from Wall Street's analysts as they raise their consensus estimates for companies away from energy all over the place. And we don't know who will be right. I would just point out that is a very wide divergence. It's a very strange occurrence. And we're going to find out whether or not the companies will come out in their commentary and back it up.
Yeah. Do we think, Kerry, that as Tom Lee says, the stock market is in a better position today than earlier this year when it made its all-time high? You agree with that statement?
Well, that statement could have various meanings. If we are talking about whether the earnings that are behind the S&P and its components are in better shape now than at the beginning of the year, I'm not sure that I agree with that.
Well, earnings expectations are up, but what if I came back to you and said, okay, it's a little nuanced, obviously, but what if I said, because of the correction that the market had, the multiple of the market's actually come down?
Yeah.
So in that respect,
yes,
can you make the case that it's in better position today? The economy really didn't change much. Earnings expectations haven't changed much. The multiples changed.
Right. So I would say that for us, because we are, I would say, more growth-oriented than value, the market seemed to have the divergence, which was part of what came with more breadth, that the Mag 7s and the tech stocks had receded in terms of investor interest. Their multiples came down. There was this big move up in the Josh Grissent Halo stocks that were putting the tech names under some pressure. We thought that had been overdone. We thought that there was too much selling of those names, and while there was buying that was justified in the other 493, perhaps when you have Caterpillar, Deere, Emerson Electric selling for 32 multiples and Google selling for 22, you needed to have some recalibration, which we now have had. I think an important factor right here is that the technology stocks, the biggest names, are 35% of the market. The market doesn't move well without them. They do not consume a lot of oil. They are not big users of energy the way the rest of the S&P is. And if you look at the needs of tech names, these names in particular, they might account for 0.5%, half of 1% of total oil need in the entire country.
You know what's interesting? JP Morgan noting that the Mag 7 yesterday accounted for 90% of the SPX's gains, okay?
Yeah.
On a record-setting gain. By the way, NASDAQ is going for 12 straight days. That'd be the longest streak since 2009. since the summer of '09. And JP Morgan's retail radar says tech saw the largest inflows since the week after Liberation Day. It plays right into what Kerry's talking about. And then you put the cherry on top of all of that. It's the fact that valuations there have compressed as well.
I want to make sure when we say tech, increasingly, it's a tale of two technology sectors. It's the disruptors versus the disruptees. It's basically, I sum it up as chips versus software, which is an overgeneralization. But I think this is really interesting. The market bottom, Scott, on March 30th, okay? Even despite the big comeback that we've seen, the SMH, the semiconductors, are still outperforming the IGV since that March 30th bottom, and I don't think most people think that's the case. A lot of people think, oh, we've had this huge comeback in the software trade. It's not true. Right. So the primary trend is still Halo Tech. The SMH is up 22%, and it's unbelievable, since that March 30th low. That's like 2 weeks ago. The IGV is up 2, but it's only up 9%.
I understand, but the IGV, by the way, just to throw it out there, is up 13% this week.
But I'm making the point that it's still being outperformed by double by the non-disruptible AI trade. And even though the IGV was in a 34% drawdown on March 30th, which is also incredible, the SMH was only in a 14% drawdown, and semi still went up. So the point is, this is not the signal to now take your portfolio and say, let me buy all the stuff that got killed. The winners are still winning. Semis went down way less than the IGV, and they came back way more. And now you might say, well, one is cheap, one's expensive. Aha! No. On a weighted average trailing PE ratio basis, the IGV is 32 times earnings, the SMH is 37. And if we want to look at the median stock in those two halves of the tech market, the median forward PE for software stocks is 19. The median forward PE for the semis, the SMH names, is 22.
Okay, so you're saying
they're not cheaper. They're acting better in a down market, and then they act better in the bounce.
Well, I hear you telling me then, and our viewers, don't be pulled in by all this.
I'm so done averaging down in these
in the software names.
Yeah. I'm so finished with
that. Look at the names this week.
Oracle is the standout.
Well, Oracle's up 29%, but Palantir's up almost 13%, CrowdStrike almost 11%. There's Palo Alto, Fortinet, Salesforce, Snowflake's up 21% this week. ServiceNow up more than 16%. I mean, it's pretty
These are stocks
incredible.
in 50% drawdowns.
Yeah,
like the context is so. It's not that there's no opportunities in these stocks. Nobody is saying that. What we're saying is, if this is about what bets you want to make as we head into the second half and finish out the first half in this quarter, it's just not true that the best opportunities necessarily will be in the most beaten down stocks.
You looking at these software names? Or do you disagree?
Well,
when they roll, everyone's going to cry. Everyone's going to cry again when they roll over.
So,
do you agree with that?
We own Microsoft. We own.
Well, it doesn't feel pretty good. I mean, outside of this week, that hasn't felt good.
It hasn't been great, but it still is on everybody's laptop. It still owns the way we communicate. It's still the leader in a very, very big vertical. You know, you just can't deny it. And it's not as if they're going to be so disruptive, because you and I are going to figure out how to put Outlook on our machine.
I guess, but look at the last year, guys. Give me a year on that. No, I know, but give me a year.
Were bad, and then it became good. Oh, I understand. It has been an
underperformance. More than 10 years. I mean,
you could have said everything that you just said 25% higher. That's the problem.
Well,
it's all true.
I understand all that. But it doesn't mean that you can't own a stock, because if they're going to start to show better numbers, which we believe that they will, this stock, you know, it has runs like Apple. Everybody threw Apple out. Last year, there were so many people on this desk who said, oh, can't own it right now. They're not in the AI trade. They're not building the right chips. There are a million reasons why you wouldn't want to own Apple. It turned out to be a very good stock after everybody had sold it. And this can happen with Microsoft. So.
All right. We have Farmer Jim has joined us. Is Jim Lebenthal. I went to the bullpen. You're right-handed, right? I called for the right-hander.
You brought in Mariano. You brought in.
I did. I looked over at the
one of the great closers.
I said, we're going to the bullpen. He got on the phone. He called Lebenthal, and there he is. He's ready. He ran in.
Looking good. And looking good.
He did some warm-up pitches. Now he's ready to go. It's good to have you. Thanks for joining us.
Thank you. Now I've got Enter Sandman in my head.
Yeah, that's all right. That's all right. What do you think about this software idea? I mean, I feel like we have a decent debate here because, you know, you're in some of these names too. And Josh says, don't believe the hype being this bounce, which certainly feels good, but in the greater context isn't exactly that impressive.
Look, I'm a believer, but look, I've believing in this for quite some time. I think it was a week ago when this rally got started, Scott, or maybe it was Monday, and I said to you, the market has said enough is enough. And at that point in time, you appropriately pushed back and said, hey, we got to have more than one day. But now we're having several days in a row. And if I look at some of the rallies in these stocks, I mean, take Microsoft. I can't believe it got down to 360, but it did. Now it's at 420. Look at Oracle. I think it bottomed around 135, and now where is it? 170, something like that. I mean, the size of the moves is telling me this is more than a dead cat bounce.